First, I think your listeners have to understand how staggering the numbers are. We're talking about a deficit in the trillion-dollar range for as far as the eye can see.
Economist John Williams from shadowstats.com, who says things are only going to get worse. He's been incredibly pessimistic.
You know, I hate being the one who has to tell you this, but it's the truth. We as a nation are headed for an economic disaster. This is a story that you should not only watch, but you should also make sure the candidates who want your vote watch as well before they bury all of us. Now, not my words. These are words being spoken by someone who's a very high authority on something like this. The reporter in this is CNN's Jeff Greenfield, who introduces us now to one man who's going all over the country trying to keep our nation from going broke.
And you've also been very pragmatic that in Washington, a lot of people are telling me that in Washington, they're not really embracing the true magnitude of what some people say is happening in the economy.
No, you know, a year ago, and you guys have talked about this on the show,
right.
A year ago, Ben Bernanke, the head of the Fed, Hank Paulson, head of the Treasury, even the president said the subprime crisis was going to be contained.
Well, first, I think your listeners have to understand how staggering the numbers are. We're talking about a deficit in the trillion-dollar range for as far as the eye can see. We're talking about deficits which are 4 to 5% of GDP, which is not sustainable under any form of government.
Here's what John Williams at shadowstats.com says about what's coming down the road.
Where are we going? We have a severe recession ahead of us with even higher inflation than we're seeing now. It's going to be probably the worst business cycle seen since the Great Depression.
That's the goal of this man, David Walker, the Comptroller General of the United States. That's the government's accountant-in-chief.
Daunting fiscal reality.
For the last few years, he's been going around the country telling anyone who'll listen that we're headed for an economic train wreck of catastrophic proportions. It's a message millions of Americans heard a week or so ago on 60 Minutes.
Serious adverse consequences.
A message Walker is happy, maybe happy's not quite the right word, to deliver to us as well, that we're spending way more than we're taking in.
Really tough choices are going to have to be made to reform Social Security, Medicare, and Medicaid, to reform our tax system, and to re-engineer spending.
Greece's debt crisis is spiraling out of control, and it looks like the situation might just have a domino effect in Europe. So who's next, and what does this mean for the rest of the world? Well, joining me to help discuss this is an investigative journalist, Webster Tarpley. Webster, thanks so much for joining me. So first of all, it seems like a lot of European markets are panicking right now, and this has already affected countries like Spain, Portugal, and Ireland. Are we likely going to see a ripple effect here?
Well, there is a ripple effect. You're in essentially the second wave of the world economic depression that began with the U.S. banking crisis of September, October of 2008. I would stress this is much less a matter of economic fundamentals than it is the commitment of a group of hedge funds and banks, a kind of a wolf pack, to attack sovereign debt.
The problem is you, if you're one of the 78 million baby boomers born between 1946 and 1964. The oldest of you will start hitting the Social Security rolls next year. By 2011, you'll start being eligible for Medicare. And that's when the real trouble begins. There just isn't enough money, Walker says, to cover what the government has promised to do.
Oh, Congressman, you've appeared several times on this program, and I've always asked you the same question. You see real economic distress, but you said it's coming 2 or 3 years down the road. Have you speeded up your time frame a bit, bearing in mind what's been happening over the past week?
Well, I worry about that I think we have months to prepare and be ready.
We should remember, on February 8th, there was this infamous planning session of a group of hedge funds at the offices of Monness, Crispy, and Hart in New York City, where they said, first we're going to attack Greece. That will allow us to attack the euro. Then we have the so-called PIGS group, Portugal, Ireland, Italy, Greece, Spain. But then they said every other kind of government debt, sovereign debt, be it nations, states, provinces, cities, or regional authorities, all of them would come under speculative attack. And that was the point made in particular by a guy called Donald Morgan of Brigade Capital. These are largely the people who helped bring down Lehman Brothers, Bear Stearns. They're kind of the wolves that gather when there's a wounded bank.
Now, back in the 1980s, Republican President Reagan and a Democratic House hammered out a fix on Social Security at a time when that system was perilously close to disaster.
We were within weeks of the checks not going out on time.
And now?
Our long-range problem is much worse, and it's very close to becoming a reality because boomers start retiring next year.
And that means some very tough choices, like trimming benefits, or having seniors pay more of their health costs, or raising taxes.
We're talking about a public debt. This is the debt that people own of the federal government that will be around 80% of GDP. Historically, it's been around 40% of GDP in the out years. The practical implications of this is bankruptcy for the United States, bankruptcy for the United States, bankruptcy for the United States.
To hold cash today is as risky as holding equities, commodities, or real estate, according to our next guest. With some ideas of what you could be doing with your money, we check in right now with Mark Faber.
In any event, your cash purchasing power diminishes over time, like the US dollar is weak. That's a symptom of inflation. It's not to have deflation really in a system, you would have to have a strong currency. As long as the currency is weak, it's a symptom of inflation.
You know, what's driving commodities is inflation. It's governments around the world, particularly the Federal Reserve, creating too much money, debasing the value of the dollar. You know, as we speak, the dollar is at an all-time record low against the Swiss franc today. It's at an all-time record low against the Australian dollar. You need $30 to buy an ounce of silver. You need about $1,400 to buy an ounce of gold. You almost need $14 to buy a bushel of soybeans. You've never seen these prices. Oil, you need $92 almost to buy a barrel of oil. But you're seeing these high commodity prices during a time where the economy is very weak. You know,
so that means as the economy strengthens, commodity prices go higher, right?
Well,
more demand?
The economy's not going to strengthen, especially with rising inflation and ultimately rising interest rates. There are a lot of people that are jumping to the false conclusion that rising interest rates or rising commodity prices somehow indicate that the economy is going to strengthen. They don't indicate that at all. They indicate more inflation.
There's no other way around it. If we maintain the proposals which are in this budget over the 10-year period that this budget covers, this country will go bankrupt. People will not buy our debt. Our dollar will become devalued. It is a very severe situation.
You know, what he's saying is that savings is way down in this country, but wealth has risen dramatically. Monetary policy is spectacular. I think Peter is just totally off base, and I don't think it's going to be, I mean, I just don't know where he's getting his stuff.
All that's increased is the paper values of our stocks and real estate. But that's not real wealth.
Of course it is.
All that phony wealth is going to evaporate.
But you're just way off base. There is nothing out there that tells us we're going to have a nice slowdown, but it's not going to be a crash.
All right, let me ask you this. Construction, whether it's mortgage brokers, real estate brokers, etc. And if that all goes away, what happens to those jobs?
There will be lots of things to fill it back up again, Michelle. It's really not a housing economy. This is an economy that's driven by good economic policies, by good monetary policy, by good trade policy, and it's working beautifully. Peter, I'm going to take a bet with you on this one. I'll bet you a penny on this one.
I'll bet you a lot more than a penny. Anytime I want to collect that penny.
Thank you. Well, I'll collect it with a nice note from you, Peter. What can I tell you, Peter? It's a bet of a penny in your honor on the stake, and mine too.
So you're typically an optimist.
Yes, I am.
So why the doom and gloom now?
Well, President Obama had, when he took office, did not repeal Bush's tax cuts, but let them expire, which means that on January 1st, 2011, Paul, you're going to get very major tax rate increases in personal income, capital gains, dividends, estate taxes, offshore investing, alternative minimum tax, Cadillac plans, I could go on. And if people know tax rates are going up next year, what they will do is they will shift income into this year, obviously to take advantage of lower tax rates now. And if they do that, that will make this year look a lot better than it otherwise should. Right. And make next year look a lot worse. And we did the same mistake only in reverse in 1981. We deferred tax cuts, and we caused, I think, the recession of 81, 82. And then we had the huge boom in 83, 84 when the tax cuts took effect. And I think Obama's going to get the mirror image of this, and unfortunately, I think we're going to have a setback in 2011.
Have you paid off that bet? No, I haven't.